All right, let's dive right in. Today, we're talking about something that sounds pretty ambitious in investing, getting annual yields of 7% or maybe even more. I
Yeah,
mean, you look at savings accounts or even bonds, 7% feels like a whole different league, doesn't it?
it really does, yeah. Put it in perspective, the S&P 500 dividend yield, often around, 1.3%? Even treasury bonds, maybe it gets somewhere under 5%. So hitting 7% or more, well, you've got to look beyond the usual stuff. And it, immediately brings up the question, can you actually do that without taking on just like reckless risk?
Exactly. That's the big question for this deep dive. We're basing this on an article, and it's got this kind of provocative title. I am swimming in dividends with plus 7% yields by Tony Hicks. And he doesn't just, speculate. He makes it sound achievable. He uses this great metaphor, swimming in dividends or harvesting income, sort of setting it against the stress of always chasing growth stocks.
It's a really powerful image, isn't it? Shifting your focus from capital gains you hope happen to actual cash, consistently hitting your account. So the author's mission and ours today is really to unpack how someone could potentially build a portfolio for that kind of high income, high and sustainable, ideally, without just being paralyzed by volatility or, hidden dangers.
Okay, so he lays out a specific strategy. He focuses on a few key types of assets. Where does he start building this high yield machine?
Well, he talks about what he called his pillars for a high yield portfolio. The first big one he gets into is business development companies, BDCs.
Ah, right. And he gives them that memorable description, something like Wall Street's back alley lenders.
Huh, yeah, a vivid phrase. And it kind of captures what they do. BDCs mostly lend to, or sometimes invest in, small or medium-sized private companies. These are businesses that, might struggle to get loans from big banks. Maybe they're past the startup phase, but not quite big enough for the public markets. And the key thing for income, the mechanism, is regulation. BDCs have to, by law, pay out at least 90% of their taxable income back to shareholders as dividends.
Okay, got it. So it's that mandatory pass-through. The interest and fees they earn from lending, that's what fuels the yield. He mentions a few he uses. Ares Capital, ARCC, yields around 9% maybe. Hercules Capital, HTGC, focusing on venture tech, closer to 10% yield. And Main Tree Capital, Maine. He calls that one more conservative, pays monthly, maybe 6.5% yield. But the trade-off, he points out, is you're really going for income, not necessarily huge stock price jumps.
Exactly. And what's interesting with BDCs, as the source highlights, is your risk is really tied to the health of those private companies they lend to, their creditworthiness. So for that higher yield, you're basically taking on credit risk, the kind a bank might normally keep on its own books.
That makes sense. Different structure, different risk profile for that yield bump. Okay, so pillar number 2 in his strategy shifts to real estate.
Correct. Real estate investment trusts, or REITs, these let you invest in, big income-producing properties, things like apartment buildings, malls, data centers, warehouses, even timberland or cell towers. And just like BDCs, REITs have rules that force them to pay out most of their income. Again, at least 90% of taxable income has to go out as dividends, and that income is mainly from rent they collect.
Right. So instead of being a landlord dealing with, tenants and repairs yourself, you own a slice of this big professionally managed portfolio, and the rent effectively flows through to you as dividends. Though the author warns, not all REITs are the same. He seemed particularly cautious about mortgage REITs versus equity REITs.
Absolutely. The source really hammers that point. Look at the actual properties, the quality of the tenants, how much debt the REIT has, all to figure out if that dividend is actually sustainable. He gives examples like Realty Income, ticker O, they call it the monthly dividend company. Known for consistency, yield maybe 5.5%. Then there's Medical Properties Trust, MPW. He mentions a yield over 10%, but flags it high risk, controversial, important distinction. And WT Carey, WPC, which offers diversification across property types, different countries even, yield around 6%.
And he makes that point about inflation too, since rents are often linked to inflation. REITs might offer some protection there. That feels pretty relevant right now.
That's a crucial link the source makes, yeah. Connecting how the investment works to the current economy, it really raises the question of, okay, how do you balance getting the yield you want with managing the specific real estate risks?
Which leads us nicely to pillar 3. This is where he says it gets a bit spicy. Covered call ETFs.
Right. This one's structured differently than BDCs or REITs. It's built on top of owning stocks. So a covered call ETF usually holds a basket of stocks, maybe tracking an index, but then it also systematically sells call options on those stocks it holds. The money it gets from selling those options, the premium that gets paid out to the ETF shareholders as income, as dividends.
Okay, so the income stream is coming from selling those options contracts. He mentions funds like JPI, the JP Morgan Equity Premium Income ETF. That one's been popular, yields often in the 7 to 9% range. And QYLD, the Global X NASDAQ 100 Covered Call ETF, aims for really high income on the NASDAQ, but he labels it not for the faint-hearted. Yields can be over 12% sometimes. And RYLD, similar idea, but based on the Russell 2000 index.
Yeah, and the key thing to grasp from the source about these covered call strategies is the trade-off. It's inherent. You generate potentially high income from those option premiums, that's the plus, but you give up most of the potential upside if the stocks themselves really surge higher. If the stock price rockets up, those call options you sold, they might get exercised, meaning you sell the stock at the agreed price, the capped price, and you miss out on any gains above that. For someone purely focused on income, maybe that's an okay swap.
It's definitely a different mindset, isn't it? You're sort of harvesting cash directly from the stock's volatility instead of just banking on price appreciation. Okay, so the fourth pillar he talks about involves individual companies. He calls them dividend stocks on steroids.
Right. These are specific companies the author likes that offer both high yields and seem to have characteristics suggesting the dividend is, reasonably safe, maybe even with some growth potential. But finding these, well, that takes more digging, more fundamental analysis than just sorting by yield percentage. You really have to look at the company's payout ratio, like can they afford the dividend from their earnings? What are their debt levels, cash flow? Is their basic business model stable enough to keep paying that high dividend?
He lists a few he holds here. Enterprise Products Partners, EPD, big energy pipeline company, it's an MLP, yield over 7%, history of raising payouts. Altria Group, MO, the tobacco company, yield north of 8%, benefits from pricing power, even with industry headwinds. And PIMCO Dynamic Income Fund, PDI, that's a closed-end fund, a CEF, uses leverage, invests in bonds for high yield, often over 13%. But he specifically warns that one is complex, volatile, not for amateurs, I think he said.
It's fascinating how varied this pillar is, isn't it? You've got energy infrastructure structured as an MLP, which has tax implications, a consumer staple company relying on brand loyalty, and then this complex fund using leverage managed by PMECO. The source really stresses that this category needs the most homework because you're betting on the strength of one specific business or one fund manager, not just a required payout rule.
Okay, so you're building this portfolio with these different pieces, BDCs for income from private lending, REITs for real estate cash flow, covered call ETFs generating income from options on stocks, and then these hand-picked high-yield companies or funds.
Right.
Given all the specific risks we've kind of touched on for each one, diversification must be absolutely critical, right?
Oh, absolutely. He frames it as like the indispensable fifth element. You have to have it. Because each of these high-yield paths has its own potential pitfalls. REITs can get hit by interest rate changes. BDCs face trouble if their borrowers struggle or default. Covered call ETFs, well, they lag behind when the market is really ripping higher. And individual high-yield stocks, they can definitely cut their dividends if the business goes south. We've all seen that happen.
So the idea is spread your bets. Diversify across these different types of assets. Maybe diversify within those types too, like different sectors for REITs or BDCs, different payout schedules, maybe some monthly, some quarterly, and even keeping some cash, some dry powder, he calls it, in something safe like T-bills. For managing risk, maybe buying if things dip.
Exactly. This whole approach isn't about getting rid of risk completely. I mean, high yield always involves more risk than a savings account, right? It's about managing that risk smartly. By not putting all your eggs in one basket, basically, making sure that if one part of your income stream hits a rough patch, the others can hopefully pick up the slack.
Beyond just the mechanics of yields and assets, the author talks quite a bit about something he calls the psychological dividend. That really struck me.
Yeah, that's where it shifts from just numbers on a spreadsheet to how it actually impacts your life.
Yeah.
He describes how having that steady, predictable income hitting your account, I think he uses a hypothetical from his own portfolio, like over $1,000 a month coming in passively, how that fundamentally changes your relationship with investing, with the market itself.
Right. You're not compulsively checking stock prices every 5 minutes. You're not freaking out about every little dip in the market. You're not quite so stressed waiting for the next earnings report, just hoping for a price jump.
Exactly that. The cash flow itself provides a feeling of financial freedom and maybe more importantly, mental peace. Just knowing your assets are working, generating income for you, pretty much regardless of the market's daily mood swings. That reduces anxiety. It lets you kind of detach emotionally from all the constant noise. It's a powerful benefit, really, beyond just the dollars and cents.
That perspective really gets to the why behind this strategy for the author, doesn't it? Okay, so finally, he talks about how someone could actually start building this kind of portfolio. It sounds like it might need a ton of money or, deep expertise.
Well, the source argues it doesn't necessarily require being super wealthy or a Wall Street pro. He says it starts with a conscious choice, a shift in your own financial priorities. Deciding that generating consistent income is actually a primary goal for you, rather than just, chasing the hot growth stocks or whatever the market average is doing just because everyone else is.
And how does he suggest putting it together? Just load up on the absolute highest yielders you can find.
No, definitely not. He suggests a more structured way, like using a core satellite approach, build a stable core first, maybe with more traditional dividend growth stocks, established companies, maybe lower yield, but a history of increasing payouts. That's for stability. And then you add these higher yield satellites, the BDCs, the REITs, the covered call ETFs, those select high yield stocks to boost the overall portfolio income up towards that 7% plus goal. He also really stresses looking hard at dividend coverage. Can the company or fund actually afford to pay its dividend from its cash flow, not just looking at the advertised yield number?
So it takes setting clear goals, being disciplined about the strategy you choose, doing the homework on whether those payouts are sustainable, and then checking in on the portfolio periodically, maybe quarterly, he suggests, not trying to time the market day to day.
Right. He makes a pretty compelling case that getting these 7% plus yields isn't some magic trick or just a reckless gamble. It's potentially achievable for someone who's willing to prioritize income, who takes the time to understand how these different assets work and the risks they carry, and who builds a properly diversified portfolio focused on generating that consistent cash flow.
Okay, so to wrap up our deep dive today, we've really explored this path towards potentially hitting 7% plus investment yields. We used Tony Hicks's article, I Am Swimming in Dividends with plus 7% yields as our guide. We unpacked his strategy, focusing on those specific assets, BDCs, REITs, covered call ETFs, and those carefully chosen high-yield stocks.
And we saw how diversifying across these different kinds of income generators is just so crucial for managing the risks that come with chasing high yield, and how important it is, based on the source, to look past the yield percentage itself and really understand if that payout is sustainable.
Right. And we touched on that really powerful, maybe often overlooked benefit, that psychological dividend. The mental piece, the freedom that can come from getting consistent cash flow, shifting your focus away from constantly watching the market to just receiving the income your assets produce. The source suggests this focus on building an income portfolio. It's something attainable. It takes deliberate focus, discipline, using strategies like, clearly prioritizing income, maybe using that core satellite approach.
Yeah, and if you connect this to the bigger picture, the source really challenges that conventional idea that investing is only about chasing capital growth. He's presenting prioritizing income as a totally valid alternative, maybe less stressful, potentially quite liberating, as a path to financial well-being.
Which leaves you, the listener, with this final thought to chew on, building on everything we've discussed from the source today. The article strongly suggests that shifting your main financial focus away from just aiming for portfolio growth towards actively generating consistent cash flow, well, that could offer not just potential financial rewards, but also a real sense of peace and control. So what could prioritizing consistent cash flow, rather than just hoping for growth, mean for your personal financial goals and maybe even your overall sense of well-being?